So let's take a look at the accounting for dividends. So a cash dividend is the distribution of earnings by a corporation to its shareholders. So if you own a share of stock in, say, Apple, and they issue a $2 per share dividend, then for every share you own, you get $2 of a cash dividend. And it's the most common form of a dividend because it's easy. It's easy to calculate. $2 a share, 50 cents a share. It's easy to calculate. And to declare a dividend, you typically have to have sufficient retained earnings because we know that dividends reduce retained earnings from chapters past. So if your retained earnings balance is $1 million and you want to declare a $3 million dividend, you don't have sufficient retained earnings to do it. But if you have $1 million in your retained earnings account and declare an $800,000 dividend, then you're covered. You also have the cash to pay the dividend. If you want to pay $1 million dividend and you only have $600,000, then you can't pay the dividend. You don't have the money. And then the board of directors has to vote on the dividend and approve it. So there's 3 important dates when looking at dividends. There's the date of declaration. The board of directors says we're declaring a dividend. That's the date of declaration. The date of record is when the owners of the shares receive their dividend. And then the date of payment is when you actually get the money. So there's 3 dates: the date of declaration, date of record, and date of payment. So we're going to assume a company declares a cash dividend on December 1st for payment on February 2nd. And here's the value of the dividend. So preferred stock, they're going to get $2.50 a share. Common stock, they're going to get 30 cents a share. So the preferred stock dividend is $2.50 times 5,000 shares. The total value is $12,500. Common stock, 100,000 shares times 30 cents, 30,000. So our total dividends are 42,500. So we look at our 3 different dates. So on December 1st, that is our declaration date. That is the date the board of directors says we're going to declare a dividend. So on December 1st, our accounting action is going to be to increase dividends and increase dividends payable, which is a liability. And then on February 2nd, when we actually pay the dividend, we decrease cash and we decrease dividends payable. Another example is a stock dividend. So instead of giving cash to shareholders, we give them stock when we declare a dividend. They get additional shares. And again, we have to have sufficient retained earnings to do it, and we have to have action by the board of directors. They have to approve it. Another thing that happens is, let's take a look at. So a stock split is that if a company has 100,000 shares of stock outstanding, they could split it and have all of a sudden 200 shares of stock outstanding. So you're splitting the stock 1 for 2, but each stock becomes less valuable. So if you own 1 share of 100,000, then you also all of a sudden own 2 shares of 200,000. So it reduces the par value. So if you do a 2-to-1 split, the par value gets reduced and the number of shares outstanding goes up. And the stock split typically reduces the market price per share. So let's back up. So let's just say we have 100,000 shares of stock outstanding on the market and it's selling for $20 a share. And our company's looking really good. So we think, okay, let's do a stock split. So now we have 200,000 shares of stock, but the price goes down to $10 a share because we split it 2-to-1. So it goes from $20 to $10. Well, now at $10, man, people really want it in our company because it's a great value. We decrease the price of our stock. So we have more shares to go around, but the price per share is less. So let's look at an example. So before the stock split, we have 4 shares, $100 par, $400 total share. We split it. We do a 5-to-1 stock split. So we take our 4 shares, now we have 20. We have 20 shares. We divide our par value divided by 5. So it goes from $100 to $20. Our total par value still stays the same at 400, but you can see instead of 4 pieces to the pie, now there's 20 pieces of the pie to go around.